Yes, well, I guess the significance, Jason, is that while the market did relatively poorly at 2.3%, good investment managers or a diversified portfolio could give you a higher return because, for example, unit trust equity funds returned between 15 to 20% last year compared to the market, which returned 2.3%.
We have here as well the JC junior market. We haven't done a lot of work on it per se, and it's a very young market. However, the market is actually the 1 year return on that market is 168%. So 1 year from yesterday is over 168%. And based on the number of expected new listings, which is likely to hit double digits in 2011, going into 2012, I think that the tax benefit that those companies receive will push that junior market, and therefore we are seeing the junior market by the end of the next 12 months to do about 20%. T-bills.
Before you move on to interest rate, Jason, because your presentation contains so much information about emerging markets and your significance to investing going forward, I think investors would be interested in your directional views for emerging market equities.
Well, I've done a lot of work on emerging market equities per se. However, my central theme is that emerging market stocks will continue to perform. I certainly don't expect them to perform as well as they did last year. But this year, I think that they'll continue to do well. The challenge, however, is that the strong growth that we saw last year with very accommodative monetary policy in terms of very low interest rates, that's going to be removed this year because interest rates are rising. And therefore, we could see a situation where the growth this year is not going to be as strong as last year. So my view is that it's a good diversification tool because very strong economies such as the Brazils and many countries in Latin America and obviously in Asia will do very well.
And as some of them increase interest rate, it could cause their currencies to appreciate and add to their equity market return.
It could. Interest rates, we think that 6-month TVs are going to trend down by 25 basis points, at least 25 basis points lower than where they are today. BOJ repo rates, the view is that rates are very close to the trough. They're very close to bottoming out. So, and that's primarily being driven by, the aforementioned inflation expectations being heightened in emerging markets, and Jamaica obviously imports almost everything that we utilize as raw material. US 10-year Treasury, I think that a year from now, 10-year Treasury is going to be 50 basis points higher than where they are today because of the improvements in the US economy. GOJ global 10-year rates, yesterday they were at 781. I think that these rates are going to fluctuate depending upon the meeting or non-meeting of IMF targets. I see rates kind of fluctuating, based on what we do. We are in a very risky zone in terms of we are in a hurricane corridor, and therefore we could have shocks, and therefore that could affect us in terms of our economic performance. Currency, as I said before, I think that's going to remain flat. I don't think that currency is going to, certainly not, we don't expect it, our core view is for it not to pass 87, 90 at a stretch. Despite the overvaluation, we think that the currency will remain in a narrow corridor because of central bank intervention, because of strong inflows from both multilateral flows and portfolio flows. Crude oil, however, I think that a year from now, crude oil is going to top 96, so 10% from where it was yesterday. Today it's declining again, but based on the growth that we see going on in the emerging economies and the demand, despite China's best effort to slow down the economic growth, we think that crude oil is going to be high. Global fixed income strategy. What are the triggers? We have what you call QE2, or quantitative easing, that's going on by the Fed, which is inducing asset prices going up. And we showed where, not only equity but commodity prices in general have absolutely been on a tear since the Fed initiated QE2. Faster than expected corporate profits, but businesses are still cautious. Households continue to save and repair the balance sheet. So A lot of consumer debt, people are saving to pay off their debts. Lingering phase of EU sovereign restructuring or EU bank failure. There's a massive risk on the horizon. Strong external balance sheets in emerging market countries. Large external liquidity flows seeking higher returns. So what's the economic impact of these triggers? We will continue to see a two-speed GDP recovery, where EM is growing faster, but EU, US, and UK are actually slow. Slow employment growth in developed world versus strong jobs growth in developing world. What's the policy mix? Well, in emerging markets, central banks are removing their easy monetary stance. As a matter of fact, yesterday I think Brazil had a press conference where they are saying all the fiscal stimulus that they did between 2008 and 2010, they are going to totally remove that in 2011. That's what we're talking about, what's the policy mix. So EM will see aggressive rate hikes, and in developed world we'll see easy monetary policy. So what will the markets do? EM rate hikes may spur increased demand for EM assets, so we could see continued increased flows into emerging market strong credits. However, there's a potential of reversal where some of these fund flows could now start going back, for example, to the US, which did very badly and not have money flowed out of it, but money can start flowing back. So it's a risk that we have to manage. Either of those two actions can occur. And therefore, what's the action? The call to action is a diversified portfolio of Latin American, Caribbean, emerging market bonds. What's the best way to do it? Again, is to invest in a fund that is properly managed, has good risk controls in place, and has a track record to give you that exposure, which again Scotia DBT offers with our Caribbean Income Fund. Or if you want to do it by yourself, you could go into individual bonds. So what kind of individual bonds would you want to go into? Our point of view right now is that emerging markets, including Central American, Caribbean, and Julia bonds, are at very low rates, yields, and there's a risk that you could have a pullback. So I would wait for better entry levels. So whenever I see bond yields rising and bond price falling, that's when I would want to go in, because that would present better entry levels. I think that these better entry levels will come in the next couple of weeks to months. For Jamaica, as early as when the next bond is issued, which could be a week or two from now. As I said before, the GOJ new issues like to present a better entry point on the GOJ curve. FX strategy, the triggers here is that we think, our view is that the local currency is overvalued by 12%. That's what our model is telling us. And we go by that view because last time our model showed us this level of overvaluation, we had a massive depreciation, well, 20% depreciation. So for all the times that our model has showed us that the JDR versus USD was overvalued, we had the correction. In this instance, we are saying that we don't see that correction on the horizon of 2011. However, over the medium term, we expect depreciation to continue. Nevertheless, in 2011, we're seeing a stable currency. What's the economic impact of that? Balance of payments will need to improve marginally to offset the overvaluation that we are seeing in the currency. And this could occur because of what's happening in terms of mining coming back on stream, and other export areas that were weak between 2008 and 10, getting some impetus from the improved, albeit weak, economic performance. Policy mix for FX, we're going to see continued central bank intervention or a managed float. Market, medium-term depreciation, we expect to resume, very slow depreciation. Near-term, over the next 6 to 12 months, exchange rate will remain range-bound. Action, the only way to do this is to adopt a portfolio approach to manage your exposure. As in, what percent of your portfolio should be in J versus US. We'd like to make the point again. Sitting in US cash, thinking that the currency is going to depreciate by 10-20%, you're going to be losing money in real terms. This has you have only made money doing that twice in the past decade. 2003-04 and 2000, between 2009 and 10. Between 2009 and early 2010. Local equity strategy triggers, as Najja explained, low interest rate implies yield-seeking investors will try to look to diversify, which they should. Improving or stuttering GDP growth, tax policy reforms on the horizon, and increased regulation, for example, the financial sector. Those are the triggers. What's the economic impact of these triggers? weak, but we have weak domestic investment. We have weak domestic investment, but we see where it's kind of improving, stable. It's not falling, which is a good thing. Better than if you have falling domestic investment. Firms will seek new revenue ideas and business models to adapt to the changing environment. So, for example, the financial sector will have new business lines coming on stream. And in manufacturing, you have firms trying to do new things, new ways of adopting new technologies, etc., because of the economic environment which we are in. Investments that did not make sense to corporations before, when interest rates were at 20%, will now start to make sense, right? We'll have challenging revenue growth, and so what we are seeing, as Najja explained, expect the banking sector to outperform, investment banking sector to be neutral, manufacturing and retail to underperform, communication to underperform. And we could add to that the fact that the companies that are listed on the junior market, we expect them to do well. Policy mix, we expect firms to adapt, look at their capital structure, because the cost of debt is now cheaper. Yield-hungry investors will look to get returns from equities. New listing on junior stock exchange will drive the market, and therefore the action here is to adapt again, diversify a portfolio of local and regional equities, as well as invest in US and emerging market, bond, mutual funds, etc.
So